The Fed just announced 0.5% increase with more to come later this year. So what does that mean for the average person? We hear 0.5% and think, no big deal. But remember, guys, the Fed funds rate is the money which they lend out to banks to go lend out to you, right? So when rates go up, your borrowing costs go up, right? Interest rates are the cost of money, essentially. So when you go to the bank and you want to borrow money, the less they're charged by the Fed, the less they have to charge you. The more they're charged by the Fed, the more they have to charge you. We've seen a big spike in inflation lately. Well, how do you curb inflation? Well, inflation is essentially prices going too high. Things are getting a little too exciting, a little too excited. People are earning too much money. Things are costing too much. Well, how do you taper that down? You raise rates. It is less likely to have people buy houses, cars, invest back in their business. It keeps buying down, which keeps prices down, which makes inflation go lower. The Fed's biggest issue right now is inflation. Now, the Fed is going to react. The Fed has reacted. People think that the Fed is going to think forward and say, oh, what do we see in the future? But they're not. Why? Because to the average American, low interest rates were wonderful until suddenly we have 8.5% inflation. Now the Federal Reserve has an incentive to go out there and increase rates. This is the chart going back to 1947 of the Fed funds rate. We were down pretty much at this level here back in 1947. But see, guys, these things go up and we had a huge jump. This is the early 80s. For those of you who are too young to know, the early 80s was a time of high inflation, but with high unemployment. The economy was stalling. So Volcker and Reagan did something that was very unpopular, and they raised rates a ton. They needed to bring inflation back down. That was unpopular for a while until it worked. I've been a big proponent of increasing the interest rates that the Fed charges because I believe in not having these massive bubbles that occur. Think about it this way. You go to the bank now, you give them $100,000 to sit in the account. How much you paid? Like nothing. Why? Because they're being charged. They can borrow from the Fed for nothing. So why would they pay you, the person essentially lending them money, a high interest rate? They're not going to. So as the rates go down and down and down, people are going to look at things like, oh, I can go pay more for stocks. I can go pay more for real estate. Why? Because I have extra income and it's better than getting 0% in the bank. That's what causes bubbles. That's what causes too much inflationary pressures on prices for anything, assets, goods, anything like that. We got away with it for a long time, but now we've had 40 years of declining interest rates. I'm hard pressed to think that the next 40 years are going to look like this. Can rates go negative? Absolutely, rates can go negative. And there was a while there we thought rates would go negative, and that's still not out of the woodwork yet. But for right now, I think that we're at pretty big lows in terms of where we're going to see the economy and the Fed funds rate go, because right now we have inflation, and inflation is affecting everyday Americans right and left. And you better believe that as much as the Fed is supposed to be an independent body that's supposed to make decisions that's good for the economy, they do hear and they do listen to the American public because they're influenced by that, especially in the social media and technology world we live in now. So for you, what does that mean? If you locked in a rate for a home in the last couple of years, be very thankful. I just sold my house the other day. I'm not looking forward to changing that home loan from 3% or 2.9% that I had to probably 5 or 6%. It is going to cost a lot more money for me to borrow on a new house. That's reality. Luckily, I have different disposable income. I can afford it. It's just annoying. That's a major factor. 2, now I do see asset prices going down. Think about it this way. With stocks, the S&P 500 was paying about a 1.2% dividend. Why? Because, hey, it's better than zero. But let's say rates go to 3 or 4, 5%. All of a sudden, the dividend rate of 1.2% isn't going to do well. So let's do the math here. If you had $10,000 in stock getting 1.2%, that's $120 a year. That dividend rate is pretty much going to be set. So in order to get 3.6%, what has to happen? This has to fall by a third, because now 120 divided by X equals 3.6%. X equals $3,300. So stocks have to fall a lot more, or companies have to increase their dividends in order to get a much higher dividend rate. Now, am I saying the stocks are going to fall 67%? No. But what I'm saying is it's going to be a combination of companies paying out more dividends, as well as stock prices coming down. Look at a real estate deal. If you have a real estate portfolio of apartments or houses and it makes $1 million a year without debt, what's the value of the property when interest rates are 3.5% versus 5.5%? Which one are the higher interest costs? This one's going to have a much higher value. So these things are going to couple itself down. It's going to drive down prices. Home building is not going to be as exciting. It might take some time, but eventually what will happen is prices will taper down. Everyone will relax. Is this worrisome? Guys, we've seen the absolute worst of times, and we've seen the absolute best of times. Guess what? Somewhere in the middle is reality, and we'll get there. We'll go above and below. At the end of the day, you've lived through assassinations, terrorist attacks, recessions, all these things, COVID, 40% drop in the US economy, 40% drop in stocks. You'll get through it. This is why we always preach, save your money, live life that you can easily afford. That way, if there's a short-term problem, you can absorb it. If you're living paycheck to paycheck, today is the day you change that.